All right, in this video, I'm going to walk through a pretty big tax benefit that benefits founders of startups as well as shareholders of startups. And the big benefit is when the company sells, the shareholders, the founders, if you own stock and you meet certain criteria, you can exclude up to $10 million of gain on that transaction. So it's a huge tax savings. It's something that I bring up to new prospects of ours, current clients, and believe it or not, a lot of these startups and their founders have never even heard of this before. So it's Section 1202, qualified small business stock. And again, you got to meet certain criteria to meet this, but if you do, it's a big exclusion. It's one of the benefits of having one of these type of companies that you're creating. So if you have any questions, leave them in the comments below. And if you haven't subscribed yet, please do so.
Okay, so here I'm going to go through some slides and then I'm going to show you an example of where you're going to report this on your personal tax return. So first of all, it's Section 1202. That's the IRS code, and it's called the Qualified Small Business Stock, otherwise known as the QSBS. And essentially, as I stated earlier, it allows shareholders of the stock, right? So you could be a founder of a company, you could be employees, you could be, investors. It allows you to exclude up to $10 million of the gain. So, for example, you buy the stock at $1,000, right? So you're exercising some options, right? So you have $1,000 into this company and the company sells for $9 million, right? You're not going to pay tax on any of this, right? Because it's, you're excluded up to $10 million. So it's a pretty big tax benefit. And the following slides here are going to, I'm going to go through some rules that you have to, stick to. So not any company can kind of do this. It's only certain companies. And, so let's kind of go through the details. So first off, the entity itself, the startup, has to be a C corporation. Okay. It's got to be taxed as a C corporation. And, the company itself, typically it's got to be around for at least 5 years. So if you're employee one on day one of the company, and the company sells, right, 3 years later, you're excluded from this, right? Because the company hasn't been around for 5 years. You haven't held your shares for at least 5 years. Okay. So that's another criteria. And, you obtain the shares directly from the company. So it's not like, you got them from another employee, right? Or you got them from some other third party exchange, right? You have to obtain them directly from the company. So again, if you're an S-Corp, this doesn't apply to you. If you're an LLC, this doesn't apply to you. And this is one of the reasons, among many, on why startups kind of form as a C corporation. So, all right, the third slide here. We talked about the C corporation. The corporation itself has to have assets less than $50 million, right? So, this rule doesn't apply to large companies, right? I mean, it says it right in the name, qualified small business stock. Okay. So the business has to have assets less than $50 million. So, assets, this is something that's on the balance sheet, right? So an asset could be cash. It could be accounts receivable. It could be fixed assets. It could be inventory. When you add all those up, if it's less than $50 million, then you're still kind of in the running here on whether you qualify or not. And the sale must be a stock transaction, not an asset. So when a company sells, usually the buyer wants to buy the assets and the seller wants to sell the stock, right? That's question number one that happens. And if the seller is successful on selling the stock, then all this kind of qualifies here. So just say your C Corp, the startup C corporation has less than $50 million of assets. You held the stock for more than 5 years, but when it comes time for the sale, it's an asset transaction. Then none of this applies, and this rule doesn't apply to you. And then finally here with the C corporation, right? There's certain industries that this doesn't apply to. So like consulting, legal, accounting, architecture, farming, oil, gas companies. This doesn't apply to those. So usually we kind of see this in like tech companies, right? Software companies. So I'm going to flip over here on this video to kind of show you a tax return. But one thing I highly suggest, right, if you do meet all these criteria, there's law firms out there that will provide an opinion. And this is more on the founder side. If you're kind of watching this video, the founder should obtain this like opinion summary memo. You know, opinions cost a lot more. I think they start out at like $50,000. Then there's summary memos, but essentially you're getting a third party to kind of opine on whether your company qualifies. Because if you exclude, you know, $9 million of gain on your personal tax return, the odds of you getting audited by the IRS is pretty high, right? And you want some substance behind that exclusion. And you is just say you're an employee or you're an investor, you're not that close to the company. You want something to kind of help kind of support all that. So we highly recommend that. And if you're, you know, you're a shareholder, you should definitely request this from the founders to kind of get this. So attorneys definitely kind of prepare these memos. They cost a lot, but think about the amount of money you're going to be saving. So let's go to a tax return. Okay. So as you've seen in my previous videos, we got Ferris and Sloan. Ferris worked at a startup and the startup sold. So he wants to kind of report this. So you're going to go to tax form 8949. Okay. And we're going to call this, and this is where you report all other, you know, stock activity, right? You own Apple, you own Peloton, all these other stocks. You're going to report that in the same section. So here is startup stock sale. That's the name of it. The date acquired, the date sold. Here are the proceeds. So Ferris got $9 million as a part of the stock sale. Okay. His cost basis was $1,000. In column F, you're going to put a Q. Okay. And then here's the adjustment, right? So you got your proceeds, what you got. Here's what you spent. And the difference between the two is this $8,999,000. If this was not a QSBS, if it didn't qualify, this is the taxable gain, right? And you're going to be paying the tax on this, which is pretty hefty. But since this qualifies as a Section 1202, Ferris and Sloan don't have to pay tax on this. So they get to exclude all this. So this is how you're going to show this in your tax return. You can see the last column here. It's kind of cut off, but the last column shows gain or loss, and it's going to show 0 here. So this is how you're going to report all that. And again, I go back to that opinion letter, and you know, I'm working with a couple companies now, or individuals who are part of startups, and they had these sales. And I'm going back to all of them to say, get that opinion from your founder. And actually they planned ahead. So some of the people we're working with are founders and they have these opinions. Others don't, and they're requesting that. And it's just, you don't have to attach to this tax return, but more likely than not, you're going to get audited, right? Because you're not paying tax on this, and this is a big amount. And it's just an easy pick for the IRS to kind of look at your return. So anyways, this is the video on the QSBS Section 1202. If you have any questions, leave them in the comments below. And if you haven't subscribed yet, please do so to my channel. Thank you.